You are welcome to this class, Financial Management. I told you in the last class that this course, Financial Management, popularly called in finance as corporate finance, has a language, and that the language of the course is what referred to as mathematics of finance. Mathematics of finance is used to capture the present value of an asset for which the future value of that asset is known. That is referred to as discounting. We can be interested in discounting the value of an asset. That is, we want to know the value of today of an asset, which amount is due for collection maybe tomorrow. Another one is what referred to as compounding. In the case of compounding, we are interested in knowing the value tomorrow of a cash flow over time, and we're interested in what will be the value of such asset in the future tomorrow. We can use either discounting or compounding, depending on whether we are talking about the future or we are talking about today. This is very important in finance because we are either talking of using somebody's money, which is an outside capital loan. In the case where loan is involved, we will be interested in paying or defraying that loan, before it's finally crystallized. Before the final crystallization of the loan, the interest and part of the capital that is due on the loan is actually paid, and in that case, we'll be interested in what referred to as mathematics of amortization, and that is through discounting mathematics. We may be interested in acquiring an asset, say in 3, 4, 5 years' time, and in that case, we need to accumulate fund over time, and this fund is not just accumulated in a laying fallow. It will be paid into an interest generating account. In that case, we are talking about a sinking fund. In the case of sinking fund, with the mathematics that is involved is compounding. We have to compound forward. All this they are very important in financial management. We do it regularly every day. And like we say that in financial management or corporate finance, we are interested in investing, and if you want to invest, there must be need for us to evaluate that investment idea. It's not just you just wake up one day and you decide to invest on X or Y. You must have properly, gone to the market to do a market survey, gather relevant data, that is relevant cash flows, and then come up with this cash flow, evaluate it using known technique or known tools, whether the discounted or not discounted tool. We get there in the next session. Using this, we'll be able to establish whether the project is worthwhile and we should continue or not. And that is why we are interested in the concept of cash flow analysis, analyzing the cash flow, that is to be used in the investment proposal. Cash flow, that is the net cash flow. When we're talking about cash flow, what do we mean by cash flow? I've explained that earlier. The cash flow could be inflow or outflow. It is an inflow when it is a fund that's generated by this project, by this investment. When it's coming to the organization, to the company, it's referred to as an inflow. When it is going out of the company, or the payment is made out of the company, money is moving out of that fund, is referred to as an outflow. There will be need for us to do a measurement of the cash inflow and outflow. This is very, very vital, very, very important in capital budgeting decision. Capital budgeting has to do with the evaluation of the cash flow and inflow with the view to taking decision as to the worthwhile of the project or the investment proposal that generated that kind of cash flow. Cash flow is important for two reasons. Number one is we are interested in the magnitude of the cash flow. By how much is the cash inflow over and above the outflow? Do we have an excess of the inflow over cash flow? Another one is the timing of the cash flow. The timing matters because we are taking decision today of cash inflows that will be generated in the future. And hence, we are going to use a mathematics, like I said earlier. We are going to use a mathematics, in which case we'll be able to place on the same platform fund that is to be generated tomorrow. We're going to discount those funds that are generated over time to today, so that we'll be able to take decision today. Hence, the magnitude and the timing of cash flow will influence whether an investment project will be positive or otherwise. The investment cash flow, therefore, is influenced by some factors. There are some key variables that are important when we want to talk about the net cash flow of a project. Number one is what referred to as the initial outlay. The initial outlay, on a project or investment project is expenses that is embarked on, before we can start the project at all. Initial expenditure that is necessary to be, to be done before we start the project at all. Such we can find examples such as the cost of an equipment, the installation cost, the cost of manpower training, that is going to be used in the course of the implementation of the project, if it is acceptable, and the working capital too. We coming into the tracking of the initial outlay. Like I said, when money is moving out of the fund, it's referred to as cash outflow. The initial outlay, therefore, you will agree with me, is an outflow. Is an outflow. It's therefore a cash outflow. Next to that is the sources of funds for the projects. Once we decide to accept a project, there will be need for us to source for fund. That is the financing of the project itself. The financing of the project by the project proposer will be either from within or from without. What I mean by from within or without is the fact that he's either we're using his own capital or he's using outside capital, external capital. That means fund that is borrowed from from creditors. In that case, it means that this interest will be paid. There is a cost attached to fund that is raised from outside the firm. In fact, the one that is internally generated is not without its own cost. It's not costless. It has its own cost too. So all this we have to come in the tracking of the source of the source of fund that is involved, the cost that is involved in the usage of fund. We have to be brought in. Another one is the inflow and outflow of cash associated with the execution of the projects. There are some inflow and outflow that will come in as a result of an acceptance to implement the projects. An investment will increase cash inflow when there is an increase in sales, for instance. Revenue will increase. Turnover, when there's an increase in turnover, revenue will also increase. When there's also a decrease in operating costs, the acceptance of a project could mean that it's going to decrease the operating cost of either two, project that is being implemented by a company. In that case, is a form of a revenue too. Yeah. On the other hand, it is an outflow if it is the other way around. If, for instance, there's reduction in sales, or for instance, there's an increase in operating cost, if the acceptance of the project will likely increase the operating cost of the company running it, then is an outflow. It's treated as an outflow. Very important too in cash flow analysis is what referred to as the timing of cash flows. There's need for us to distinguish, like I said earlier, to distinguish the period for which these funds are coming in, because the fund that is made at the end of year one will be different from the fund that is coming at the end of year two, and it also will be different from the funds that is coming or going out at the end of year three, and so on and so forth. And so because of this, we will use the mathematics when we are doing an evaluation that will take care of the difference in the timing, of the cash flow that is coming to, that's involved in investment proposal. The next concept that we needed to consider when we are doing a cash flow analysis is the impact of the investment on the firm's other sources of cash flow. It's not impossible that the acceptance or rejection of an investment proposal, especially the acceptance of an investment proposal. Let's take that one first. The acceptance of an investment proposal will have implication on the company other sources of funds. For instance, suppose the acceptance of one project will lead to a reduction in the production of already existing product of the firm. That this have an implication. So if there's be a decrease in net cash flow, because we are accepting one project, there's a decline in what is already in production. There's going to be a decline in net cash flow. Another one is if the acceptance of a project will likely create an additional cost that will increase the cost of the project. This will also have a cost implication for the project on hand. All these are referred to as the opportunity cost of accepting this current project. The opportunity cost of accepting this current project is the alternative foregone. And this alternative foregone could be the fact that an increase in an existing project, increase in the cost of an existing project, which of course will increase an outflow. But it could be the other way around, a reduction, which will be, of course, will be an inflow in this case. In the case of an increase or a decrease in other sources of fund of the company. We also have what we refer to as the salvage value or the scrap value of an asset. The scrap value of an asset is the value of that asset at the end of its economic life. The economic life means the useful life of that asset. Most assets, if not all assets, has its useful life. At the end of the useful life, the asset is having a market value, and the market value of that asset, therefore, is not just there for nothing. It can still be sold in the market and to still bring in money. That will be a cash inflow. A cash inflow if at the end of the day the scrap value or the salvage value is disposed of. That is when the it will be an inflow. And we move to the next concept, which is the concept of relevant cost and income. In the last discussion or the last session, I discussed the determinants of net cash flow. These are also relevant. These are also costs that are very relevant when we want to do a capital budgeting. That we want to evaluate an investment proposal as to determine whether it is to be acceptable for implementation or not. We have such important costs such as the initial outlay, expenditure on materials, labor, other items. These operating costs, of that as an opportunity cost, like I've explained earlier. All this will be costs, that have to be taken care of when we are tracking the cash flow of an investment proposal. On the other hand, we have what we can refer to as the income. The income will be cash inflow from the projected sales, the sales or turnover on that asset, of the product, or service that is going to be rendered through that investment idea. It will be the expected income for project proposal. We also have a very important concept when it comes to the tracking of the cost and income, and this has to do with the tax issue. There are tax issues that are involved. Tax, we normally take funds out of the firm. Times is the tax is an obligation to the government of the day. Most companies, except these days that we have so small, micro, small and medium enterprises by the Act of 2020, Finance Act 2020, that is excluded them from paying tax. But before now, we had almost all companies that are registered with CAC must pay tax. Thank God that now we have a relief, right? But for such companies that are not qualified to get such relief of being excluded from paying tax, they must necessarily pay tax. But that's not the whole story. The whole story is the fact that in the tracking of the tax that is due to be paid to the tax and the tax authority is the fact that that tax can actually be reduced by making an allowance for the use of capital, and we refer to this as depreciation. In the tracking of depreciation, we use a number of methods to track the depreciation that is due on an asset. It could be a straight line method. Straight line method, in which case we have an asset that is has a useful life of 10 years. In that case, we have the value of that asset, divided by the number of years, will give us how much to be charged at depreciation, annually. We also have what we refer to as a redeem balance method, in which case we have a percentage attached in any given time will give us what is the depreciation due, at that point in time. The third one is what we refer to as sum of the year digit method, which is we use a formula to get the depreciation that is due, annually, and this is charged to the P&L. It's charged to the P&L before the determination of the tax to be paid. You agree with me, therefore, that by the time you are charging your depreciation to the P&L, it will have in a way reduced, the amount of revenue that is due to the company to be taxed, because, of course, like depreciation is not to be used when we are tracking the cost. We are, of a project. The cash outflow. Sorry, using the proper language, the cash outflow of a project. Depreciation is not to be charged because it doesn't involve the movement of money. It's just a provision. Any such transaction that doesn't involve the movement of cash out and into the organization is not taken account of in the tracking of cash inflow and outflow. But however, like I said, the depreciation will become important because it will be important in tracking that, because it will enable us to be able to know how much to be paid to the tax official, and to have in a way she does a bit, because we have charged it to the P&L before we determine the tax to be paid. In a proper claim, in the modern language, we refer to that as capital allowances. Government in the annual budget will always give the direction to operating companies in the economy in the form of the capital allowances that are chargeable in any given year. We all refer to as the initial allowance. We have the annual allowance. We have the investment allowance. All these are charged on the assets or charged on the investment proposal. Sometimes government will allow investment allowance of say 100% investment allowance, which means that company for that period may not have any kind of obligation to the government at that point in time. But capital allowance will always be worked out in a sense in which case it will end up after we have done the mathematics of allowing for capital allowance on the asset or an investment proposal, done in such a way that it will end up in either a charge or an allowance, a balancing charge or a balancing allowance. Is the balancing charge, of course, which is chargeable to the P&L, wherein the scrap value of the asset, the market value of that scrap value of the asset is still higher than the written down value. We have the asset we have written down over time. The market value of that asset is still higher. Is referred as a balancing charge, which is chargeable to the P&L. If it is the other way around, that is it is referred to as a balancing allowance, which is deductible from the P&L. Having said that, there's need for us to demonstrate, to do a little demonstration of how to, in reality, track cash flow in an investment proposal. Refer to your textbook, you see what referred to as the case study 6. In that case study 6, you find a question on OUPFC. Is an investment proposal by this organization, is a new organization, and we consider a new investment being a new organization. The cost of that investment is given as 12,000 naira. You see, that's your question. The decision is important because it's not because we want to track it as cost, because it will, in a way, attract the method of tracking or the time that is to be paid, as you do for payment. It is expected to have a service value at the end of its life. The improvement is expected to result in an increase in annual revenue, that is cash inflow. Annual revenue is an inflow of 7,000 naira, and an additional cost of 3,000 naira, that is an outflow. This could be, we just use this, it could be millions or billions, but just let us use this very simple example for your understanding. Not including the position and of the equipment. The income tax is 50%. What is expected cash inflow at the end of the day? You see that very simple example. We know that in column 2, the second column, we have the revenue. The cash flow inflow is 7,000. That is, you can see the cash flow in the 7,000. And you can see all these operating costs, they are nothing but outflow. The operating costs, they are cash outflow. And this is 3,000 naira. 7,000 naira, the difference between 7,000 naira and the difference between 7,000 naira and 3,000 naira is 4,000 naira. The next slide is telling us that the depreciation that is due. I will not go to the details of the completion of the depreciation that we are doing in our elementary accounting. If you use this method, you find that we get a depreciation of 4,000 naira. The method that is used is sum of the year digits. If you use the sum of the year digits, you get a depreciation of 4,000 naira. But however, you see, the depreciation is 4,000, Like I told you earlier, division is actually not needed. What's needed is, that the division will enable to reduce the tax to be paid. Because in the first year, therefore, what is the tax to be paid? We see that the difference is 4,000 naira and division is 4,000 naira, and therefore leaving zero as for the tax to be paid. On the other hand, you see the 7,000 naira, that is the revenue. You remove 3,000 naira. What are you left with? You are left with 4,000. If you still remove your tax from 4,000 naira, what will you get? The tax is zero now. Know that the tax is zero. If you remove the tax of zero from your 4,000 naira, what do you get? You get 4,000 naira. And that's how we arrive at 4,000 naira in the first instance there. Move to year 2. If you use 7,000 naira, here the revenue, the other cost 3,000 naira, the difference is also 4,000 naira. From 4,000 naira, if you therefore remove tax, the tax that is due for payment is 400. The tax that is due for payment is 400. If you remove 400 naira from 4,000 naira, we have an inflow of 3,600 naira. You remember that before you get your tax, you must have posted your what? You must have posted your depreciation, and that is how the tax is determined. And deduct your depreciation from the revenue, the net revenue. And hence, we are given, the revenue as if the net revenue is now 4,000 naira. What will be the tax? You remove depreciation of 3,200 from 4,000, that will be 800. And if tax is just 50%, you see that will be 50% of 800 will be 400. That's how we arrive at 400. But however, in tracking the cash inflow, it will be that you are deducting 400 naira from the net income of 4,000, which will give us 3,600. We move to year 3. For year 3 is 7,000. Our fees, operating costs, it's not fees. I mean that the figures are fees for simplicity. Operating cost of 3,000. The depreciation is also given. The depreciation for that year 2,400. The tax that is due for payment using that regular method is 800 naira. If we deduct 800 naira from our 4,000 net income, because 7,000 minus 3,000 will give us 4,000 naira net income. If we deduct tax that is due for payments of 800 naira, we have 3,200. 3,200. You still recall how we get our 800 naira. This will be the net income minus depreciation of the net income is 4,000 minus depreciation of 2,400. That is 1/6, and 50% of that will be the tax, which will be 800. That is how we track the tax that is due for payment, and the tax is to be deducted from the net income of 4,000, which will give us 3,200. For year 4, the same procedure is followed. That is for our 4,000 net income. If you deduct 1,200 tax that is due for payment, we have 2,800 naira. And for the 5th year, we also follow the same method. The net income of 4,000 naira, I think you understand that. 7,000 minus 3,000 give us 4,000 naira. So the net income of 4,000 naira, if you deduct your tax, 4,600, we have 2,400 naira. You agree with me that the posting of depreciation to the P&L have actually assisted in limiting the tax that is payable. If we are to pay tax, for instance, direct from the income, in year 2, let's say year 2 as a case study, we have a net income of 4,000 naira. If you are to pay tax directly, from that amount, it will be how much? 50% of 4,000 will give us what? Will give us 2,000 naira. So the tax for that year will be 2,000 naira. We'll see how eventually we are paying for 400 instead of 2,000 naira. This is so what we refer to as capital allowance there for depreciation is a provision, and the government is given that kind of provision to be enjoyed by companies so that they can set apart a certain amount of money, capital assets, so that there will be enough fund in the provision for the replacement of that capital asset, and the company can therefore continue on a going on concern basis without any interruption. We can go via the formula. You see in your test, you have seen the formula that you can use, such that for each of the years, we may not go into the tabulation that we have on this slide. We can use the formula to get the net cash flow for each of the years. That is why we have that formula, which we derive at, or which we give, which we number as equation 7 the other time. is let's refer to it. Let's give it the nomenclature of cash flow analysis formula, if you like. It's telling us that the revenue is what we refer to as the R minus the cost, into 1 minus T. What tax. When you move tax from the net income, what we have is when you move tax from the net income, that is cost minus revenue. You have the net income, then there will be the need for us to remove tax. Then you can see the tax sheet effect plus the tax sheet effect. That is tax change D. Tax change in depreciation. Tax, that is the T, into change in depreciation. We give what the tax sheet effect plus the tax sheet effect. The formula is really the beauty of what the transfer we just talked about. The tax sheet effect of capital allowance or depreciation as generally allowed by government for company to utilize. Having said all of this, we can give I decided to look at some other examples, in which case wherein it is possible for us to be able to make differential between the amount of an existing machine and the machine that is proposed. Wherein we are selling the old machine and we are recovering a new. We are buying a new one. The difference between the cost of the new machine, minus the proceed of the old machine, and things like that. That is what is meant by incremental cash flow. At the beginning of this session, I think that our interest is on incremental cash flow. If you have a machine that you're already using, say for instance, we're already using a car, to run our business. Now we want to dispose the car and buy a new one. The cost, of course, we are going to, the cost of the new one will be depreciated or will be reduced by the sales proceed of the old one. That is incremental. So our cost will have been reduced by this amount of the proceed of the old car, incremental cash flow. The same, this can also happen in our form, in which case it could increase the income of the company, like I explained earlier, or reduce the income of the company. Wherein opportunity costs, such as the one I just explained, are involved. This is briefly what we refer to as the cash flow analysis. We generate most of this figure by actually going to the market. That is, practically they are generated by going to the market, doing a market survey. We know the number of units of goods to be produced. We go to the market to see the current market price, so we'll be able to get the revenue, the turnover that's expected from the offering of the service or from the sales of the product. And we also go to the market to generate the cost of other material that are involved. The operating cost we have done the stimulation and of the cost of labor and other material that are involved, so that we're able to bring the cost close to reality. Not just sitting there in the office or sitting somewhere and cooking all these figures. No. We know the current depreciation of capital allowance that's allowed by government. So it is possible, therefore, for us to be able to come out with the net cash flow over time for a number of years. And once we have the net cash flow over time, we have the data that is required for us to work with in evaluating the worthwhileness of the project, or that investment proposal, using a method, or a technique, either you're interested in non-discounted cash flow method or discounted cash flow method. Sometimes we use both of them, together to be able to take a decision as to whether this cash flow we project for the company to go ahead and implement the project or not. I want to sincerely thank you for listening.